The former U.S. president is insisting that the EU purchase gas and oil worth $350 billion, a figure raising eyebrows across the energy sector. Let's examine these numbers to understand their implications. At current European gas prices of around $500 per 1,000 cubic meters, Trump's demand would translate to approximately 700 billion cubic meters of gas. This volume is significant given the European economic landscape. The demand is particularly challenging due to Europe's efforts to reduce energy consumption. The continent's industrial sector is experiencing a downturn, making such massive purchases improbable. European consumption levels are unlikely to return to their 2018-2019 peaks soon. Many view Trump's statement as a negotiating tactic rather than a serious proposal. Known for his business approach, Trump appears to be using these numbers to pressure Europe into more favorable energy deals. The timing is significant given Trump's tariff policies, which have contributed to economic cooling and reduced energy consumption. This approach to energy diplomacy comes as U.S. domestic energy production continues to expand. The situation highlights the relationship between energy markets, international relations, and economic strategy. While Europe seeks to diversify its energy sources, the continent must balance these efforts against economic realities and infrastructure limitations. Industry experts suggest that such demands might complicate rather than facilitate energy negotiations between the U.S. and Europe. The question remains, how will European leaders respond while managing their energy security concerns and economic priorities? In a significant development for global energy markets, former President Trump's push for American LNG in Europe has revealed complex dynamics in international energy trade. Our analysis shows an intriguing paradox in the current negotiations between the U.S. and European markets. The situation presents a contradiction. While high-level discussions aim to secure long-term commitments for American gas exports to Europe, U.S. energy companies prefer the spot market, where they can capitalize on price fluctuations for higher profits. Industry expert James Mitchell explains, American energy companies are playing a different game than politicians. They're looking at maximum profitability through flexible pricing rather than locked-in agreements. The timing coincides with Trump's recent statements about implementing new tariffs across trading partners. This creates uncertainty in energy markets, with analysts predicting either stable prices or increases approaching summer. Summer doesn't mean reduced gas consumption as many might expect. Despite no heating needs, Europe experiences significant energy demand during warmer months due to air conditioning. This creates a year-round demand pattern affecting pricing and supply negotiations. The European Commission seeks to diversify energy sources away from Russian supplies. However, the transition faces challenges in infrastructure and pricing. Mark Thompson, an energy market analyst, notes, "We're seeing a fundamental shift in European energy policy, but implementation is more complicated than political statements suggest. Market dynamics, pricing mechanisms, and infrastructure determine the feasibility of such transitions." As these developments unfold, the energy market watches how conflicting interests between political ambitions and commercial realities will be resolved. The outcome could impact global energy trade patterns and pricing for years to come. In today's breaking news, we're examining a complex situation in European energy politics, causing significant debate among international observers. The story reveals a contradiction in European energy strategy that's costing taxpayers billions. European nations are in a difficult position, balancing political aspirations with economic realities. While declaring intentions to reduce Russian energy dependency, they're spending more on Russian LNG than on aid to the northern Black Sea region's defense. The situation is complicated by Donald Trump's involvement. Trump has positioned himself as a key player in this energy chess game. European leaders seek support for energy alternatives while trying to avoid premium prices for American gas. Countries like Hungary, Slovenia, and Serbia continue receiving pipeline gas through Turkish Stream. Europe's substantial LNG purchases from Russia create an awkward diplomatic situation, contradicting stated political objectives. The timeline for phasing out Russian gas has been pushed to 2027, revealing practical challenges in implementing energy transition plans. Europe faces three competing pressures. 1. Maintaining affordable energy prices. 2. Reducing Russian energy dependence. 3. Negotiating with the U.S. over alternative supplies. European decision-makers are trying to maintain flexibility while minimizing costs. This balancing act is proving expensive and politically challenging. Trump's negotiating style, pushing for clear commitments, complicates the situation further. Market analysts suggest this energy dilemma could persist for years, as Europe lacks sufficient alternative infrastructure to quickly change supply chains. The situation highlights the gap between political rhetoric and economic reality in European energy policy. We'll continue monitoring these developments and provide updates as the situation evolves. In a striking development that highlights shifting global energy dynamics, Europe finds itself in an increasingly precarious position regarding its energy security and negotiating power. Recent analysis shows that European threats of imposing tariffs on American products appear ineffective when compared to their growing dependency on U.S. energy resources. The situation has become delicate as Europe scrambles to secure diverse gas supplies. A bright spot emerged from Egypt, where favorable weather conditions resulted in surplus gas availability for European markets. However, this piecemeal approach to securing energy supplies underscores Europe's vulnerable position in the global energy marketplace. Europe faces fierce competition from rapidly growing Asian markets, which consume gas at an impressive rate. This competition for limited resources further weakens Europe's negotiating position, especially when dealing with major suppliers like the United States. While Russia has frequently been accused of weaponizing energy resources, it's now Donald Trump who appears to be using America's energy abundance as leverage. His demand for Europe to purchase $350 billion worth of gas and oil from the U.S. places significant pressure on European nations already struggling with energy security concerns. This development marks a shift in transatlantic relations. Europe's traditional ability to negotiate from a position of strength has been eroded by its increasing energy dependence on the United States. The situation becomes more complex when considering the volatile price environment and delivery challenges in the global gas market. The question now isn't whether Europe can threaten the U.S. with meaningful countermeasures, but rather how it can maintain energy security while navigating these diplomatic waters. The continent's effort to diversify its energy sources highlights the limited options available in the global market. For European policymakers, this presents a complex puzzle. How to maintain strategic autonomy while ensuring reliable energy supplies in a market where traditional power dynamics are rapidly shifting. In a striking development that highlights global energy politics, former President Trump's push for European energy markets reveals a paradox in international relations. Our analysis shows how Europe's approach to energy suppliers varies based on political alignments. European nations have long employed a distinctive formula. You don't understand, this is different. This becomes evident when examining their energy purchasing decisions. While Russian gas offers competitive pricing and logistical advantages, European leaders have prioritized political considerations over economic benefits, especially regarding events in the Black Sea region. The situation complexifies with American gas entering the market. Despite similar marketing tactics and higher prices, U.S. gas gets marketed as democratic energy. Industry experts note this creates a situation where identical business practices receive different responses based on their origin. Europe's industrial capacity to handle such energy transitions remains crucial. The fundamental question is, will European industry survive until American gas deliveries materialize? Trump's demand for $350 billion in energy purchases poses challenges for a continent facing reduced consumption and economic pressures. The narrative involves NATO relationships and military positioning. While concerns exist about U.S. troop movements, European leaders appear more comfortable with Trump's negotiation style compared to Putin's, despite similar market tactics. This situation highlights a geopolitical shift in energy markets. Europe balances between maintaining industrial competitiveness and aligning with political allies, even at a premium price. The question of whether European industry can sustain itself under these conditions remains crucial for the continent's economic future. Our analysis suggests that while political considerations dominate energy decisions, practical implications for European industrial capacity may force a reassessment of these priorities. Energy market analysts are questioning the feasibility of former President Trump's demand for Europe to purchase $350 billion worth of American gas and oil, citing concerns about the European energy market's absorption capacity. This story exposes the complex reality of Europe's energy crisis, which predates current geopolitical tensions. Our investigation reveals that Europe has been grappling with an energy crisis since 2017-2018, before the current situation involving Russia and the West. The market's stability has been undermined by regulatory changes and attempts to reduce dependency on Russian energy supplies. The European energy landscape has been shaped by the Third Energy Package restrictions, designed to combat Gazprom's market dominance and reduce Europe's reliance on Russian energy supplies. These measures have led to a more complex and expensive energy market. Without long-term Russian contracts, which provided stable, formula-based pricing, European energy costs have become unpredictable. This has resulted in pressure on government budgets as states attempt to shield populations from soaring energy costs. The challenge of meeting Trump's proposed purchase requirement becomes more apparent when considering Europe's declining energy consumption patterns. Market experts note that such volumes would be excessive for the current European market. Our analysis indicates that the European energy market's complexity has increased, making it harder to attract resources and manage costs. The situation has created a perfect storm, where reduced supply options, regulatory constraints, and market instability challenge any large-scale energy agreements. This developing story raises questions about European energy security and the implications of major energy trade proposals in today's geopolitical context. In a concerning development for European industrial stability, recent reports reveal significant miscalculations in energy infrastructure investments, particularly in Germany's liquefied natural gas sector. Analysis shows one of Germany's primary LNG terminals operating at merely 6% capacity, highlighting challenges in predicting energy demand in today's volatile market. This infrastructure miscalculation comes at a hefty price, as regasification terminals represent substantial investments. The underutilization signals declining industrial activity across Europe, marking a shift from the robust manufacturing base observed in recent years. Industry experts point to a transformation. Europe appears to be transitioning from an industrial powerhouse to a more agrarian-focused economy. This shift represents a fundamental change in the continent's economic structure. Energy consumption patterns show consistent decline, with manufacturing facilities either scaling down or closing. The situation reflects challenges in energy planning and infrastructure development. As Europe works to reduce dependency on Russian energy while maintaining economic stability, the costs of new import facilities and distribution networks have become burdensome. Some analysts suggest this might accelerate Europe's climate goals, though not as initially envisioned. Rather than through planned transition, the change occurs through deindustrialization, raising questions about the region's future economic competitiveness. Remaining industries face uncertainty, with only the most resilient expected to survive. The current industrial landscape differs significantly from 2016-2017, with energy consumption metrics indicating a structural shift in the European economy. This development coincides with efforts to diversify energy sources and build new infrastructure, though the German terminal's low utilization serves as a cautionary tale about long-term energy infrastructure investments in an unpredictable market. In today's breaking news, we examine a crucial development in the independent media landscape, highlighting the growing challenges faced by information outlets in maintaining editorial independence. Our analysis reveals a concerning trend where news organizations are increasingly pressured to seek corporate sponsorship, potentially compromising their ability to deliver unbiased reporting. This is particularly relevant as we observe the ongoing energy crisis in Europe and negotiations with the United States regarding gas supplies. Former President Trump's recent demand for the EU to purchase $350 billion in gas and oil from the US has sparked intense debate. This situation exemplifies why maintaining independent energy analysis and reporting is critical. As Europe grapples with reducing its dependence on Russian gas while facing pressure to increase American LNG purchases, the need for unbiased information sources becomes paramount. This is especially true when covering sensitive topics like the situation in the northern Black Sea region and its impact on global energy markets. To maintain our commitment to independent analysis, we're expanding our presence across multiple platforms. Viewers can now follow our updates on Telegram, vContact, and Zen, where we provide real-time insights into energy markets and geopolitical developments. As we continue to cover the evolving situation and its effects on global energy markets, your support becomes increasingly vital. The complexity of current geopolitical developments demands thorough, unbiased analysis.